2010 was a mixed year for investors in China, with equities sagging while the RMB gained and commodities boomed. For a look at what's in store for 2011, we're joined by international investor and longtime China bull, Jim Rogers, who joins me from Singapore. Jim, now inflation in China is a major concern as we start 2011. How much tightening do you actually expect this year?
Well, I think there'll be more tightening in China because the Chinese do have a serious inflation problem, as you mentioned. They know it, I know it, everybody knows it, and they're determined to kill it. They didn't act very tough in 2010, but now they realize they've got to go more, so watch for more tightening in China.
How much tightening do you think we'll see?
I don't know. I'm not smart enough to know. What will probably happen, Tora, what usually happens is governments start tightening up to try to do something about inflation, and they keep tightening and they keep tightening, and usually they go too far because, you know, there's always a lag effect, and they start getting impatient. So I suspect you will see more tightening than one would normally expect. They will go too far, like most governments. Then inflation will stop. Then you should buy all you can.
With that in mind, further tightening and global commodity prices, how will it affect those global commodity prices?
Well, whenever you have a slowdown in an economy, it causes slowdown in demand. It's pretty simple economics. On the other hand, Tora, we now have serious shortages developing on the supply side of many, many commodities. I mean, I don't know if you've tried to buy any rubber recently because it's almost impossible to get because there just isn't a supply. So you can have prices continuing to stay strong or even going up with demand slowing down because we have supply problems. We have wheat problems, sugar problems, lots of things have problems of supply, which is equally as important as demand.
How then are you positioning yourself for that in 2011?
My way of playing China continues to be the same way we've discussed before. I own the renminbi, which I expect to continue to go higher. And if you have renminbi, you're going to get higher and higher interest rates, at least the way I see it. So you'll get a double whammy on the return. And to continue to own commodities, because whatever happens in the world, if the world economy doesn't get better, Western governments anyway are going to print a lot of money, and that's going to add to the demand for commodities. My way of playing 2011 worldwide is currencies and commodities.
You seem to like the renminbi, at least in terms of appreciation. How much can it appreciate this year?
Oh, I'm not smart enough to know that, Tori. You should watch Thomson Reuters. You have people on Thomson Reuters every day who can answer those questions and tell you exactly what's going to happen and when. I just know it's going to go higher. I own the renminbi. I don't plan to sell it. If you look at the Japanese yen over the past few decades has gone up 400% against the U.S. dollar. They still have a balance of trade surplus with the United States. So the renminbi can go up much, much, much higher over the next several years.
Now, you've said in the past, in terms of stocks, you're almost entirely invested in China, at least index-wise. That didn't quite pay off in 2010. The Shanghai index down more than 10% over the year. So what will it take for this to turn around in 2011?
Well, I don't know if it will turn around in 2011. What I said before, and just to clarify what you said, I said most of the stocks I own happen to be in China. But to clarify further, most of my portfolio has been commodities and currencies, and that continues to be the case. As you talked earlier, the renminbi's up, commodities are up, so 2010 was a very nice year. What will turn around the Chinese stock market? I'll tell you when I plan to buy the Chinese stock market again. If and when there's another collapse, if and when prices drop dramatically for whatever reason, and I don't know why they would, but if they do, that's when I will buy Chinese shares again. The government is tightening up. They are trying to do something about speculation in real estate. They are trying to do something about inflation prices. That could lead to another drop in stocks. I didn't say it would. It could. If it does, then I hope I'm smart enough to buy more Chinese shares.
If you're buying more Chinese shares, commodity shares, or would you be looking at consumer stocks, for example?
Probably not consumer stocks for me. I would buy stocks, if it happens, I would buy stocks where the Chinese are trying to put huge amounts of money. I would buy water stocks or agricultural stocks or infrastructure stocks or tourism stocks. You know, there are many, many aspects of the Chinese economy where the government is very supportive of some major changes, including tourism, which I guess is a type of consumer issue. That's where I would put my money. But I don't want to buy any shares anywhere unless there's a big drop.
Jim Rogers in Singapore, many thanks for joining me today. I'm Tara Joseph Hoy. This is Reuters.